So I want to go through Chee Soon Juan's blunders for myself, specifically the times when the SDP got facts wrong or POFMAT. So let's start with the most recent one for this video. With the headlines from 8 days, elderly hawkers say their bakery stall had dropped in sales after Chee Soon Juan's FB post wrongly states it shuttered. Let's go by the facts only. On 25th May 2025, Chee Soon Juan posted a video which started with some examples of F&B outlets closing. One of the examples was Bakes and Bites. The purpose of Chee Soon Juan's video was to talk about the rising cost crisis in local F&B, and it was an invitation for people to talk about it at his cafe. 27th May 2025, Bakes and Bites wrote an email to Chee correcting the video, saying that Bakes and Bites is not a cafe, but a stall in Old Airport Road Food Centre and that it is still in business. They also posted in the Facebook group Hawkers United, saying that Chee's post has caused harm to their business and reputation, and they wanted to clarify that it is still operational. They also thanked 8 Days for their exposure, here referring to an earlier article published on 8th May 2025 that they have seen a surge in demand. Someone, presumably someone from the SDP, replied on Chee's behalf, apologizing and saying they have removed the video and re-uploaded an amended version. 8 Days says this edited version was posted 27th May, but checking Chee's Facebook as of writing, it's re-uploaded 28th May. And those are the facts we can gather. It certainly seems reasonable that Chee Soon Juan is receiving flack for not fact-checking. Then 9th June, Chee visited the shop and apologized for the mistake, and this was also published on the Bakes and Bites Facebook page. Though in his apology video, he also promoted his cafe. So anyway, the drama is technically over. But I want to examine if the story made sense in the first place and also if Chee Soon Juan's video had a point. Because what I don't think most people caught is the assumption that is made in the article. Though it is not clear if this came from the writer of the article or the owners. The header in this section says, "Video had immediate impact on biz." In the section, one of the owners recounts how she felt the business dropping after Chee's video was posted. Then 8 Days ends this section by saying, "It appears Dr. Chee's post had pretty impressive reach." The owner said, "Before that, our daily sales averaged around $568, but on May 27 and 28, it plunged to $157 and $131. Indeed, the timeline matches, but the classic correlation does not equate causation applies here. Common sense tells me it's simply more likely that an average Singaporean goes, "Wah, 36 degrees today. Better go aircon place to eat." Than to think, Chee Soon Juan says this place is closed. I better avoid Old Airport Road. Looking for someone to blame is just ignoring the huge context that the hawker business wasn't doing well, even before both positive and negative media coverage. That 568 average day likely came after 8 days exposure, and we know this because that article wrote that they were not drawing salary due to escalating rents and other costs. They also said that some days biz is okay, some days it's poor. The drop to $100 plus days could very well just be that. Some days it's poor. If you look at Google reviews, a lot of reviews came after that 8 days coverage. But the thing about media coverage is that it tends to only result in temporary bumps. And $568 a day might sound a lot until you include costs. A random search gave me a stall for rent at $3,200. Suppose ingredients and other costs would make this $7,000. $568 per day on a 6-day workweek basis would give roughly $14,000 revenue, or for $7,000 profit. It's certainly livable wages for two, though it is below median salary. Still, it is not to a point of not drawing a salary. The cited drop to $100 plus days would also be in line with the satay bihun uncle's earnings, which, using a translation, rent, utilities and gas add up to over $3,000. Some days he only earns $100 to $200, sometimes he's barely breaking even. Of course, this isn't the same for every stall. If you look at a popular stall, a roast meat stall with 782 Google reviews, we can refer to this 2016 article by dollars and cents. And going straight to how much they make, for the first 3 months they were losing money, but over time they started to get customers, and as of 2016, get about 200 customers per day. With a monthly cost of 13,000, this is about 900,000 gross profit split among two people. The numbers are a bit outdated, but it's still median salary range even for a popular stall. So, Old Airport Road Food Centre is also managed by NTUC Food Fair and not NEA. The smaller details about the differences are relatively opaque, which makes it hard to say if that's a bad thing. But this Today Online article says that 3 years after the social enterprise model was rolled out, it has failed to live up to its promise. Scrolling down, there are complaints by hawkers with several issues, such as not having the freedom to adjust food prices, high rentals, and auxiliary costs. Specifically at Old Airport Road Food Centre, crockery collection fees for several hawkers have risen 40% to $580. Well, that was in 2018. Go to 2024 and there's the piece by Makan Sutra complaining about SEHCs again. NTUC specifically was an example that KFC didn't like. So going even more recently to November 2024, Old Airport Road Food Centre got a new renovation. But what's the problem? Poor ventilation. Of course, the various responses from those interviewed are mixed, but I think we have managed to paint the picture that Old Airport Road hawkers aren't exactly living the best life here. And there's one more thing that everybody living in Singapore should know that happened in May. 6 consecutive days of sweltering heat between 34 degrees to 36 degrees Celsius. The Smart Local is a website that knows exactly what people would search for to maximize clicks. And what did they write for in May? 9 coldest places to escape to when the weather is sibei hot outside. None of these are hawker centers, obviously. Then there's also the 2 other places mentioned in Chee Soon Juan's video. Those are actually also inaccuracies since they are not closed but closing. Floor Patisserie's lease is ending July and their regulars are still going. Wine RVLT announced their closing date as 12 July 2025, and in the Instagram post, which has the same image as SDP used, Wine RVLT clarified that they are still open. But you'll notice that these two didn't say anything about Chee Soon Juan, and they definitely still want to keep going on if they can. If Chee Soon Juan's factual inaccuracies had that much impact, these two would be making a big fuss too. So, Redditors pointing out that the couple was so desperate that they're selling 3 pies get 1 free, pointing blame at Chee Soon Juan, I don't think that is correct at all, considering everything we established so far. Even without what we said that hawkers were struggling way before Chee's post, Bakes and Bites had this promotion back in 2021. When Old Airport Road reopened in 2024 after renovations, they also did special promotions. And these kind of promotions are obviously common in the food industry. Now, it is certainly possible that Chee's video turns potential customers away. His videos do get about 100k views when he's on camera, Facebook numbers alone. But Chee Soon Juan is also primarily a political figure in a country where people don't really care about politics. Even if we assume that there is a huge overlap of food media with Chee Soon Juan videos, we're talking about just a few seconds of a video versus the other factors that could affect the business, including media coverage waning, the extremely hot weather that makes people not go to places without aircon, an unprofitable line of business given the economics of hawker trade, among other things. There's just so many factors at play versus just one factual inaccuracy. If Chee Soon Juan had that much sway, let's be honest, he would have won Sembawang West, and he wouldn't need to close that second outlet. Given the facts, I don't really believe that Chee Soon Juan is solely responsible for the drop in sales. $50 per day, I can believe. Few $100 causing your business to collapse? Unlikely. But I don't like how it seems even SDP supporters are looking for someone to blame. Remember, Chee Soon Juan's video wants to find solutions to F&B shutting down due to rising costs. What's the point of blaming the people they are trying to help? As of now, SDP's ability to fact-check remains in question. So let's also check the actual video. First, Chee cited the number of F&B closing in 2024. These are the same numbers in SingStat, so it is accurate. The reason some F&B are closing we've already covered, and that's also accurate. So the numbers need to be taken into context by comparing them with the F&B opening, which they did. Though not sure why the SDP would use numbers from Lianhe Zaobao when the updated numbers are available on SingStat. But anyway, those numbers are not inaccurate. Plotting numbers across the years, we actually get a rather healthy looking graph with both openings and closings increasing. Of course, analysis matters more. The claim is that SMEs are not protected from the influx of businesses from overseas, especially China. Let's look at the articles that Chee showed for more context. The Bloomberg one is a newsletter and tells us an excerpt from a Knight Frank report. Increasing competition and a substantial number of overseas brands have led to a Darwinian retail environment. Further down, it is explained that these chains from China looked abroad as the economy slowed with stagnant consumption. Singapore, with a large ethnic Chinese population, was the obvious target. The Business Times interview with the ASME president tells us something similar. Smaller firms here are facing a red ocean as foreign competitors with deep pockets and their own suppliers set up shop in Singapore. Rising business costs and labor shortages are the two top challenges faced by SMEs. While these may give a quick boost to the economy, he believes their presence will weaken local SMEs. And all these are led by geopolitics and the enhancements to the China-Singapore Free Trade Agreement completed in 2023. As an added sanity check, let's also look at Knight Frank's latest report. The first page reiterates what's already been said, with the high costs and high numbers of closing and opening. The second page now tells us that there are no apparent mechanism to control supply, asking if there should be some form of regulatory control. And the market outlook directly tells us that it's starting to do more harm than good. Savills, another real estate firm, says that market optimism continues to support rents. But they recognize that the foreign establishments mean that headwinds are growing stronger for local brands. Going straight to the outlook, F&B establishments from North Asia continue to open in central locations and are willing to pay premium rents. Tight supply in the near term and sustained leasing demand are expected to continue driving prime retail rents. But sluggish domestic spending is likely to dampen suburban areas. It's a more neutral positive outlook, but still reiterates the point that local SMEs aren't having the best of times. So another one, let's also look at DBS's report on F&B and retail REITs. The four major points are summarized here already. Profitability of F&B operators under pressure due to increased competition, especially from lean, hungry, and cash-rich Chinese F&B operators. And since F&B spaces remain hot, you see DBS gives buy ratings for the REITs. The interesting thing here is probably their observation on listed F&B stocks. Because of the challenging competitive landscape, listed F&B players are trading at depressed valuations. So this isn't good news for the company because your ABR, Jumbo, Kofu wants their share price to be high. Low share price generally means the company isn't expected to do well, but for stock traders and investors, DBS believes this might be an opportunity because previous cases of privatization had a premium to the last traded prices. So, all in all, Chee Soon Juan's point that local SMEs are harmed by the influx of foreign competition is supported by sources other than the ones he cited as well. Chee next says that Singapore's GIC fueled the rise of foreign competition, citing the example that they invested in Luckin Coffee. And then says that our system is willing to back foreign entrants over local businesses. The ultimate betrayal, he calls it. And this is also sort of the point in this video, since he also repeated the point at the end of the video. So for context, let's look at the Luckin Coffee story. In June 2018, Luckin raised $200 million USD from investors, including GIC, placing its valuation at around $1 billion. Then after various funding rounds, valuation kept increasing until IPO in May 2019, at $17 per share would make it roughly $4 billion valuation. Then December 2019, Luckin overtook Starbucks as China's largest coffee chain. 2020 is when things started going downhill. Short seller reports started coming in. Then in April 2020, internal investigations showed that sales transactions were fabricated, causing shares to fall 81% the next day. So immediately, the media started questioning. But I don't think GIC lost money here based on this Financial Times article. Here it says GIC sold down its direct stake to less than 1%, but still holds an indirect stake through an investment in Centurium Capital Partners. Note that Centurium is also held by Temasek, but we don't know how big a stake this is, and even if Temasek still holds it, it's a small position of their 389 billion Sing dollar portfolio. Anyway, Centurium still held a lot of Luckin Coffee even after the scandal. So after being fined by the SEC, Luckin fired the people who needed to be fired, and Centurium gained control of Luckin Coffee. And that rise and fall is easily seen on the stock chart, going from about $40 per share to nearly $1 after the scandal, and today it's back to about $35. Even if you don't follow stocks, you might have seen those Luckin Coffee stalls all around the CBD area. And according to this CNBC article, many international chains use Singapore as a stepping stone for global expansion. Because we are a hub, a financial center, it gives good visibility to international visitors. So, on the surface, it does seem true that GIC fueled the rise of Luckin Coffee, as Chee Soon Juan said. And he does have a point. There have been so many cases talking about rents putting small businesses out. And you can read this article yourself, but nothing new we don't already know. One bakery with lease going up 15%, 5 shophouse business closed or about to close, sports tenants with rents going up 20%, and this particular gym went up 57% since 2018. Just Straits Times giving examples. Then there is Seville's again, talking about how malls have little room to reduce rents and that international brands can afford higher rents, and also saying that there is more the government can do. SG Tough, which has been here since 2020, one of their concerns are obviously rents. But if we take things from GIC's perspective, their goal is just to enhance the value of our reserves. And among the 3 entities we have, GIC is the designated entity to invest in global assets because we want to avoid concentration risk. Fundamentally, because the purpose is to maximize returns, they are just going to invest in assets they think will do that. Of course, there are guiding principles like investing sustainably, and they follow something called the Santiago Principles. But companies wanting to come in, even by paying premium rents or possibly pushing out local businesses, that's not really GIC's job scope. Whether GIC invests or not, those companies will still come in anyway. So let's go outside of what Chee Soon Juan mentioned. I think we've already established that the SDP has a point, even though they get certain facts wrong. The question is, should the GIC or perhaps Temasek invest in local companies? And this is a question brought up multiple times in various commentary articles. Here's one in May 2024 talking about SGX reviewing a document from the Singapore Venture and Private Capital Association. So, of note, the SVCA includes GIC and Temasek among other firms. The problem with Singapore Stock Exchange is low volumes and questions over corporate disclosure practices. Delistings frequently outnumber listings. High concentration of businesses in which Temasek has a stake. And this is in contrast to regional exchanges preparing for IPO revival. Then scrolling down, one of the suggestions is to allow pension and sovereign money to be invested into the stock market, as seen in Australia or Thailand. So we don't know where this suggestion came from, but it is seen by GIC and Temasek. Outside of this, here's a commentary made April 2024, and here the commenter identified 3 critical ingredients for financial hubs. Singapore has a healthy startup ecosystem and wealth management, but lacks liquidity. And here he points to GIC and Temasek as potential candidates for supplying a baseline liquidity. Why is this required? Because companies can no longer use our stock market to raise money. There are so little people in Singapore stock market that shares are trading at 60 to 70% discount to assets. Then there is the geopolitical risk if our stock market doesn't allow local companies to raise capital locally. Well, a year later, this same writer made another commentary. What happened to Singapore stock market? And once again, low liquidity comes up as a problem. The writer tells us that small companies find it difficult to cope with high compliance costs due to SGX's regulatory regime. And once again, a call for government-backed funds like the GIC to invest, although he acknowledges that the EMRG initiative was a step in the right direction. And you might be wondering how we went from cafes to the stock market. Well, if there are very few attractive investment opportunities outside of REITs, then investors are going to invest in REITs, thus creating a rent chasing situation, at least in theory. So, the government has answered the question of GIC investing into Singapore stock market. They say it's not the solution. But it's also somewhat of a non answer since instead of answering the purpose of the question, which is to revitalize the stock market, their answer just says it's the rules. Although Chee Hong Tat says there are plans to work with industry partners, maybe this was referring to the EMRG. And that's everything I've read to understand the tenant situation. It's very complicated and it doesn't seem easily solvable without broader strategies. Maybe rent caps and balancing the foreign versus local tenants is enough, but it doesn't seem like it's in the interest of landlords to support that. Maybe a healthier local stock market can relieve the pressure from REITs if investors actually have alternative investments. I don't know. I'm just a scared boy, and I just want people to focus on the problem rather than looking for people to blame.